As a former athlete, my coaches always told me the best offense starts with great defense, and trading is exactly the same. Most traders don't struggle because they can't make money. They struggle because they don't know how to keep it. The difference between average traders and professionals is that professionals know when to attack and, more importantly, when to protect their profits. We call this defensive trading. And in today's video, I'm going to break down 2 examples of the hidden clues professional traders use to protect their profits. Also, at the very end, my good buddy Jason Graystone is going to share his opinion on the matter as well, so make sure you hang on until then. All right, let's learn to trade. Here on the New Zealand dollar, we had a nearly picture-perfect example of a head and shoulders pattern. Now, the head and shoulders pattern is a classic chart pattern that's typically used to identify potential reversals in the market. And there was nothing wrong with the pattern itself. However, what stood out to me was the small but very important detail of overlapping structure sitting right above the neckline. So let me draw this in for you. Our head and shoulders starts with a clear directional move down, followed by a brief retracement. That brief retracement is going to set up our left shoulder, and the high of that retracement is going to end up being the left side of our potential neckline. We then get an extension down. That's going to end up being the head of our head and shoulders, followed by a deep retracement all the way up, which ends up being the right side of our neckline. We then get one more brief retracement down, or we can call this a failed extension as well, which ends up being our right shoulder. And then the head and shoulders pattern is validated once the neckline is broken or violated, depending on your rules. And the neckline could be drawn in 2 ways. One way could be a horizontal neckline where you connect the dots from the left shoulder right over here to the right shoulder right over there. You can see this slightly upward slanted trend line. Another way would be taking the highest point of the neckline, so in this case it would be the right side, and just drawing out a horizontal line there. Again, it doesn't matter which way you do it as long as you're consistent with it, but the breach or the violation of that line is what's going to validate this pattern. Now, as far as entries go, there are different ways to enter the head and shoulders pattern. And for this particular scenario, we're going to take the approach of an aggressive trader. So a trader that wants to get involved as soon as that neckline is broken. And in this case, that means they would have been involved either right as this candle broke the neckline or after that big green candle closed. And you can see price really hasn't done much after that. And part of that is because of one major clue, or for me at least, one major red flag that stood out, and that is an area of overlapping structure. If we look back to the left beyond our left shoulder, and I get this head and shoulders thing out the way, we're going to see these 2 candles right here with high wicks to the upside. Those high wicks are going to represent a level of rejection, meaning that at some point price action spiked down, we retrace back up, we spike down again, we retrace back up before eventually falling to the downside. And those highs of those spikes are going to represent important levels of structure because those are the extreme levels that the bulls were able to push to before they eventually got rejected by the bears. And I call this an overlapping level of structure because it is a small, often hidden level of structure that occurs right above the main level of structure that we're often paying attention to. And in scenarios like these, it's very easy for a trader to be tricked. And what I mean by that is once they see the violation of that neckline, they think they're in the clear, but forget about the level of resistance that is hiding right above them. And that level of resistance hiding above there is often a level used by bigger traders to bait smaller traders into doing things that help bigger traders make money and smaller traders lose money. And how do I know this? Lots of market research, yes. Talking to some of the smartest individuals in the industry, yes. But also personal experience of losing lots and lots of money only to realize why I lost lots and lots of money. Again, our trading mistakes are often the greatest lessons we have if we decide to use them that way. So in this particular example, defensive trading simply comes from shifting our approach to the market. Instead of being aggressive at this first level right here, we may say, hey, I need to see a break and close above this higher level before I get interested in this trade. And what that does is not only keep us out of a potential loss, especially if we are really aggressive traders, but it still allows us the opportunity to get involved in the trade We just need that higher level to be violated instead of that smaller one. So again, it's a very subtle difference, but it's an important one. Waiting for price to clear that additional level of resistance can help filter out false breakouts and save you a tremendous amount of money and frustration in the long run. You see, sometimes the smallest details make the biggest differences in trading. If you're serious about mastering chart patterns, I highly recommend adding the Encyclopedia of Chart Patterns by Thomas Bulkowski to your library. Whether you're studying the head and shoulders pattern that we just covered, or the ascending triangle that we're going to discuss next, or dozens of other formations, it's an incredible reference guide. Now, it's not a book that you read cover to cover. It's one that you keep on your desk and revisit whenever you need deeper insights into a specific pattern, its characteristics, or some cool historical data behind it. I've linked both the second and third editions in the description box below if you want to check it out. All right, let's jump back into lesson 2. In this second example, our defensive mindset comes into play through profit target selection, and specifically choosing the safer profit target instead of the sexier one. You see, on this chart, we have my absolute favorite breakout pattern, and this one's called the ascending triangle, and it's actually a pretty simple pattern. What we are looking for is for price to make equal highs, so a horizontal level of resistance right up here. And again, these things don't have to be perfect, but you guys can see what I'm looking at. And then on the downside of this pattern, we have a series of higher lows. Now, in this particular setup, we do have a clear directional move coming before the ascending triangle. This is going to be called a bullish flagpole. You don't necessarily need this for an ascending triangle, but it is a benefit, especially if you're predicting a bullish move. But the fact is, or I guess you can say the psychology behind this pattern is this: price action has given us a clear directional move to the upside. We then have a retracement. This is all normal, right? Price extends and then it takes a breath and gives us some periods of relief. Price then retraces back up and retests that previous high. And once again, the sellers are able to defeat the buyers and push them down again. However, what's interesting is that each time the sellers are pushing it down, they are gaining less and less ground. And our expectation is that we will eventually see a breakout to the upside. And that's exactly what we did here. So you can see there's absolutely nothing wrong with this pattern. And it actually did play out the way we would expect. It did break out to the upside, only briefly. And this is where a lot of traders get into trouble. You see, one of the traditional ways of placing targets off of these type of patterns are taking the range of the pattern. We're going to ignore the flagpole for this example, but the range of the consolidative part of the pattern and then adding that to the high. So what I want to do is I'm going to take the length of my highest high right here and drag that move down to the highest low right there, I guess the lowest low, excuse me, right there. And then what I would do is I would project that equal length breakout to the upside, giving me a profit target right up here. Now, if you know anything about my trading style and more specifically my philosophy on trading when it comes to teaching other traders, it's that I'm not one of those coaches that says there's one way to do things. I understand that there are endless ways and techniques and tactics and strategies and methods that you can use in trading to be successful. But what's important is that you have a core philosophy and you center your trading around that core philosophy. For me, that core philosophy is two things, specifically when it comes to target taking. One is I believe in structure. I believe that structure acts as a magnet. Price action is magnetically pulled into structure. It is magnetically pushed off of structure. So whenever I'm looking to identify areas of interest where price is likely to go next, I like to do so by identifying key levels of structure. Two, I also don't believe in random things. I don't like random stops, right? Stops like 10 pips away just because they're 10 pips away. I don't like targets in random places. I like my targets to be at a place where I believe price is actually likely to go, and that's based off my technical analysis. So when we look at doing something like this, a simple equal measured move, yes, there is a harmonic notion to it, but it really doesn't take the main thing that's in my philosophy into account, which is structure. You can see this target location is just in the middle of no man's land. When it comes to structure, however, if we look at our next structure level, this zone right here, this is the area that I would expect price to go to. And lo and behold, price actually went to that level before breaking back down. So how does this help us in this trade? Well, it's a little bit of addition by subtraction. We're actually making money by not losing money. If once again, we're going to take an aggressive approach to this trade and say that we're going to buy as soon as we get the break and close above that horizontal level of structure, that's going to give us an entry right here at, what is this? This is going to be 197.43. Now, if I'm measuring my stop loss, my stop needs to go below our previous swing right here. That's going to be the safest place. Yes, there are different methods for stop loss. You can get right beyond the entry candle as well, but we'll just take kind of a normal one for this type of video. And if I'm looking at a profit target up here at that 1-to-1 breakout, boom, I've got a 1-to-1 risk reward and everything is set up great. However, what you can see happens in this scenario is that although we do get a little bit of a break to the upside, we then crash back down and eventually we are stopped out, putting us in a losing trade. And this is something that really used to frustrate me as a trader and something that really motivated me to get better. And it was placing trades, watching the move go in my direction, but not go in my direction enough for me to actually make money. And in all of my years working with traders, this is one of the most common mistakes that I see. You would think that a lot of traders are bad at making predictions or bad at getting involved in trades, but that's not actually the case. Most traders that I work with, most traders that I see actually aren't bad at identifying those type of things. What they're bad at is putting their stop loss in the right place. Typically it is too short or too far away. Too short means that they don't give the market enough room to breathe and they're stopped out prematurely, only to watch price go back up in the direction and hit their would-be targets. A stop loss too far away means that, yes, they're wrong, but it took them too long to understand that they were wrong, and now they took an unnecessary loss. We see the same thing with targets as well. Sometimes targets are too close where they don't get enough out of the trade, and that messes up their whole risk profile for later on. Or, like in this case, their targets are too far away, and although price action actually follows through with their prediction, they don't actually make any money off of it because price ran out of steam before getting to their targets, only to turn around and stop them out. And I'm telling you, once I put a very specific and intentional effort on getting better at placing stops and placing targets, I became a much better trader, and it had nothing to do with any major changes to my trading strategy. So in the case of the trader that took the random 1-to-1 target, this would have been a situation where unfortunately they lost, but they kind of were right, but just not right enough. Now, if we take the scenario of a trader who is looking at that level of structure, things are going to be a little bit different. Let's say we enter at the same area right here, the close of that candle. Our stop's going to be in the same place below these lows right here. But let's say we're looking for targets at the highest close of our level of structure. So right in here. Well, now you can see that we would have made targets, but actually we would have never been in the trade. Now, I know that different traders have different risk reward requirements and they all don't need to be 1-to-1, but I find it very hard to believe that a trader would consistently want to put themselves in a position like this where they have a vastly negative risk reward, especially on a trading setup that isn't going to win you 90% of the time. So when you go through your 3-part trading checklist, entries, stops, and targets, right? The 3 things we need to know before we ever take a trade, this would end up being a non-trade because the risk reward just doesn't make sense. So what does a non-trade mean, you ask? Well, it's exactly what it sounds like. It means that you just can't trade it. You have to wait for another opportunity. But going back to that defensive mindset as we compare both traders, Trader A took a loss of about 96 pips. Trader B never got into the trade, so they lost nothing. And again, it's addition by subtraction. Most traders don't struggle with making money. Most traders struggle because they give too much money back. So by avoiding a loss, you're pretty much giving yourself another win. And that's what we want to do as defensive traders. And if that concept still doesn't make sense, listen to what my good friend Jason Graystone has to say about it, and it may clear things up for you.
All right, today I want to tell you about one decision that I made that completely changed the way that I traded. And ironically, it was the day that I stopped trying to make money. And I know that might sound ridiculous. Surely that's the whole point of trading, but bear with me, because that shift in thinking is what almost every profitable trader goes through, at least that I've seen anyway. Because a lot of beginners, they open a chart and they immediately ask one question: how much money can I make from this trade? Professional traders ask a completely different question. They ask, how much am I willing to lose if I'm wrong? And that might sound subtle, but it isn't. It's everything. It's everything in the differences between profitable trading and not profitable. Because once your focus moves from making money to managing risk, your behavior changes completely. So let's just imagine that you've got a 20 grand trading account. Most beginners see £20,000 available to trade, but professionals don't. They mentally divide that up into hundreds of tiny little pieces. Maybe they decide that they'll never risk more than 1% on any single trade. Well, that means that every trade has a maximum loss of £200. And they don't do it because they're expecting to lose. It's because they know losing trades are part of the business. Now imagine they lose 5 trades in a row. Beginners panic. But professionals, they've simply lost 5% of their account. Is it annoying? Yes. Is it catastrophic? Not even close. They're still in the game. They've still got chips at the table. And staying in the game is the whole point, because every strategy has losing streaks. It's the traders that survive them are the traders that eventually become profitable. So something I'd like you to think about today, think back over your career, your job, whether you're in management or sales or engineering or healthcare or teaching or running a business. You already understand that no worthwhile career has a perfect success rate. Projects fail, clients leave, deals fall through, but you don't question your profession because of one bad week. Trading's exactly the same. One losing trade tells you almost nothing, but 20 trades tells you a little bit. 100 trades begins to reveal whether your process actually works. So the lesson here is judge your trading the same way you would judge your career, over time, not just one outcome.
Jason Graystone and I have over 35 years of combined market experience, and our goal is to help you see the things we've learned throughout those years without having to pay the same prices that we did. If you want to learn with us or watch us break down the markets live, head over to www.tier1trading.com and check out the 14-day risk-free trial membership. That way you can come see what we're all about before making any type of commitment. Like and hype this video before you go, and I'll see you this weekend for another Trading Edge video, or maybe sooner for another episode of the Trading Coach Podcast. See ya!